Hey traders, Jason here from Levitt Brothers. So I'm going to do an update of my State of the Market series. We're going to talk about a few of the indexes. We'll get into some breadth readings. We'll talk a little bit about seasonality. We'll talk about where money is flowing. Talk about where, which groups are doing better or worse right now. All right, let's get into it. All right, let's keep it simple here. Here's the S&P 500 monthly chart. Looks really good. We got a big rally here, 2020, 2021, a large cup and handle pattern, and then we have, since last November, it's just been up, 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 up. We got, 9 out of 10 months. This close is an all-time high, all-time high, all-time high, all-time. So not only do we have 4 months in a row that have closed positive, we have 4 all-time high closing months in a row. Lots of quant studies that look at winning streaks and such will point towards, pretty high odds the market is up, 6 months, 9 months, 12 months in the future. So things looking good. Could it correct? Could we have some sort of a pullback? Absolutely. We had a 5-month win streak here and then a 3-month correction, and then boom, we had a 5-month win streak here, 1 month off, and then it went up. Could we have a month or two off over here and then a continuation? Sure, it could happen. But overall, market is strong, it's healthy, it's doing well. We should view weakness as an opportunity to buy quality stocks at a lower price, not as a reason to panic. All right, so this is the S&P 500, closed at an all-time high, but we did not take out the July high over here, so keep that in mind. Here's the global Dow chart, which is approximately 42% the US and then 58% the rest of the world, just pointing out that it too closed, not only closed at a new high, but it closed higher than July. Does that mean we should stop trading U.S. stocks and go look elsewhere? No, but it just means that the strength that you're seeing in the U.S. is also in much of the world. Okay, it's not just concentrated here. There's pretty good strength all over the planet. So there's some good backing here. It's not just the U.S. Zooming in a little bit, here's the S&P 500 weekly chart. Look, we don't trade the S&P 500. I mean, you probably hold some of it in some mutual fund you have, and that's fine. I'm just looking for, is it trending up? Is it acting well? Is it adhering to key levels and moving averages? And the answer to all those questions is yes. Okay. I mean, you can go back all the way to October of 2022, which is 22 months ago. Trend up, 3-month correction, and basically a trend up since. We have a little correction over here last spring, and then we had a little correction over here. And other than the carry trade gap down, it basically just, over here we bounced off the 21 and continued up. Here, other than the gap down right there, which we immediately recovered from, it was just move to the 21 and move up. So everything looks good here. We got, the index is moving from bottom left to top right, trending up, acting orderly. Everything looks great. A little bit, if there's a little bit of a warning, it's just that volume recently has been on the lighter side, but otherwise looks really good. Here is the Russell 2000 small caps. It has not traded like everything else. You got a big range over here for a year. You got a 2-year range over here. You got another 7-8 month range here, and now we have who knows what's going on here. It's like a news that interest rates were going to go up or come down. The small caps broke out of their range. Then the carry trade brought it back down hard, and now we've recovered. So I don't know what the real market is here. The small caps are unchanged going back almost 4 years. But if you look, if you focus on just the last year, we got higher highs, higher lows, and it's moving from bottom left to top right. So small caps are they're doing fine. It's not like they're lagging that much. I certainly wouldn't be overly concerned right now. I think this breakout is more indicative of what's going on than this drop. Okay, so I think small caps are doing just fine. Here's Now let's get into some breadth readings. On the bottom chart here is the NYSE AD line. I mean, this is like higher highs, higher lows. It's just like trending up since last October. Notice that like when the market fell here, the AD line actually pushed to a higher high. And then when during this entire move down here, which was, what is that, like a 3-month low, the AD line actually easily put in a higher low. Okay, so beneath the surface, the advancers were either beating decliners, or if decliners took the lead, it was by a very small margin for a very short period of time, because the AD line has been trending up for a long time with only a few minor dips along the way. Zooming in a little bit, this is the large cap AD line, new high, mid cap AD line, new high, small cap AD line, new high. So strength is not concentrated in any of the market caps. New highs across the board, all market caps are participating. Here is the large, medium, and small cap AD volume line. So the AD line lets all stocks have equal say. It doesn't matter if you're $1 trillion company or $1 billion company, you have equal say. This is the volume, okay, which is also not equal say, because you can have a smaller company that trades a lot of volume or a larger company that trades less volume. But so nothing is perfect, but you look at the combination of all of them and it starts to paint a picture. So we got large cap AD volume line, new high. Mid cap AD line broke out a few weeks ago and is now consolidating at a new high. Small cap AD line broke out a couple weeks ago and also is consolidating at a new high. So regardless of market cap, more volume is going into up stocks than going into down stocks. Okay, here is the S&P 500 versus S&P 1500 stocks above their 50-day moving average. Okay, so S&P 1500 is going to be the S&P 400, 500, and 600 combined, stocks above their 50-day moving average. We got a print here at 76%. That's good, but not fantastic. It tells us there's room to grow. I don't see any major warnings here. Warnings come from this, where the market is like pressing higher, but then this print is sitting at a lower level. Okay, that's kind of a warning. Like that can persist like for a short period of time, but if it persists longer, it's going to bring the market down. It happened over here too, where the market was pressing higher, but we had prints that weren't at extremely low level, but certainly low enough to be notable. But this print here it's a solid print. There's no major warnings here. It's not so high that it's like overbought and we'd have to think that we're going to fall back down. We don't have a divergence forming yet. Divergence is kind of like this, where you have market goes higher high and the indicator goes lower high. But even that takes a couple months to play out. Like divergence is like you can say there's a divergence here where that's market moved up and that's lower high, but again, that's a couple months. So I think this is a good print, not a fantastic print. The fact that it's not fantastic tells us there's room to grow. Certainly it could fade within its range here, but there's no major warnings here. We don't trade the indicator, so you're just looking for like, hey, is this indicator giving us the green light, red light, yellow light? Does it tell us what to do here? And the light is green. The market's trending up, and this is a good enough print to suggest that participation is pretty good. Here's a different look. Here's large cap, mid cap, small cap, new highs. All right, so large caps pretty much have matched previous highs. Mid caps, there's definitely been a fall off. Okay, lots of new highs over here, but mid caps have not made as much progress to get back to their high. The S&P is very close to its high. NASDAQ is further from its new high, from its high, and then mid cap, small caps are lagging even more. So you can see like small cap new high, a lot less of them. So it's something to keep an eye on. Is it urgent? Is the market immediately doomed? Not yet. Okay, not yet. A lot of divergences take time to play out. I mean, if I look at right here, where there was a fall off in new highs, came here, the market actually moved up for a few more weeks before it fell. Okay, so it's one of those things. Keep an eye on it. Okay, keep tabs on it. I'll look at something like this every couple of days, couple times a week, just to see if there's been improvement or if it continues to lag. But it doesn't necessarily mean something is urgent right now. Okay, but it's definitely worth keeping an eye on, because especially if the market keeps pressing higher, we need an expansion of new highs. We definitely need an expansion of new highs to let us know that that participation is there. And then so that was 52-week highs. This is 1 month high. So SP up top, down below is 1 month highs. Ideally, like this over here is ideal. This is kind of perfect. You want like moving like this, and then occasional dip down, and moving like this, and occasional dip down, and moving like this. That's an ideal situation. So we had that over here. Okay, and then we had a big plunge, which makes sense. But now we've had a recovery. And remember, this is only 1 month high. The S&P is at like a 6-week high. It's not at a 52-week high, but it's at a 6-week high. So we're going to want to see some improvement here. And then if we have an occasional flush, and then some improvement here, and then an occasional flush, that's fine. That's what we're looking for. So this print's above zero, which is good, but I wouldn't say it's high enough to be truly supportive of a strong market. So we want to see improvement from the highs and the lows on look-back periods. All right, let's look at some seasonality stuff. This is the percentage of time a particular month, for the S&P 500, closes above where it opens. Okay, so for the last 5 years, there you go, 5 years, May and July closed above where it opened all 5 times. And you can see September, it is 0, not once. We've had 5 years in a row, actually 4 years in a row, because this year hasn't happened. We had 4 years in a row where September closed below its open. This is in concert with the belief that September is the worst month of the year, blah, blah, blah. It is historically the worst month of the year. But you don't want to just quit and give up and just assume that it's going to be weak, because this is the last 5 years. If I go back the last 20 years, now it's not so bad. This 53% is still one of the worst months of the year, but it's not like it's at 25%. It's not down here. It's 50%. January is 50%, 55, 58, 60. Like, it's definitely one of the worst months, but it's not like it's 25%. Like, 53% last 20 years. That means 10 out of the last 19 years, the market September closed above where it opened. So we can't go into September just assuming it's going to be a terrible month, okay? It could be a weak month. It could be an okay month. We don't know. This is just kind of a lukewarm reading. But you definitely don't want to just assume that it's going to be a weak month, shut it down, and then you get 2 weeks into the month, it happens to be a good month, and then you realize, you wonder why you missed a bunch of trades, and it's because you just anchored to one particular seasonality stat that said September is going to be weak, and then you just kind of gave up on the month. So it's definitely a bad month, but it's not horrible. Okay, one thing we need to be aware of is how money is rotated. Okay, that's probably the biggest point that I want to make so far, because the monthly chart was in great shape, the global Dow in great shape, the weekly charts, breadth has been good or supportive and not warning of anything. But the one thing that has happened recently is there's been money that has come out of growth names and gone into a little bit more defensive names. So here's the SP 500 versus low volatility and high beta. So you can see low volatility, up, new high easily, and then high beta names, which are going to be some of your tech names, which move faster, are putting in a very obvious lower high. So there's been a shift towards people coming out of tech and going into low volatility. Okay, similar chart. This is value versus growth. So value has been trending up, only a minor disruption over here. At the carry trade low, and you can see with growth has put in a very obvious lower high. So maybe not a very obvious, but you get the point here. So money has come out of growth and gone into value. Looking at, so here is the sectors over the last month, and you could see that just to highlight what's going on, it's like consumer staples has been one of the best. Utilities has been number 1. Consumer staples number 2. Real estate number 3. Okay, so staples, real estate, utilities over the last month have been the best groups. Okay, so that's a little bit of a hint where money has been moving. Okay, it's come a little bit out of your traditional tech names and gone into some of these defensive names. Over the last week, it's looked like this. Okay, and you see last week, tech was weak. This is mostly Microsoft and NVIDIA. Consumer discretionary, which is mostly Amazon and Tesla, and then communication services, which is mostly Google and Meta. Those were your weakest ones. Meanwhile, financials did really well, and industrials and materials did really well. Okay, so there's been a flow of money. Okay, so overall market's doing well. It's pretty strong. It's pretty healthy. The most notable change is just that money has moved a little bit from like growth and high beta stuff into some defensive names. Not a huge issue. It's just something you got to be aware of. If you're a trader, you want to be fishing in the pond where you have the best opportunities. And right now, some real estate and industrials are doing better than a lot of tech names. Now, the other change we got to make, or at least adjustment we got to make, is when you're playing tech, you tend to you can make 20-30% in a week or two, but when you're playing industrials, you might only make 10 or 12% in 2 weeks. So you got to tone down expectations and not think that big money is available. I hope this helps. Hope you got something out of it, and I will see you next time.